Tonight, Canadians standing strong in the face of growing tariffs.
President Trump is shaking up the system, and we have an opportunity in this crisis to build out our export markets and to build a Canadian economy once more.
Imagine this. You are finally ready to build your dream home. You have the plans drawn up, the costs figured out, and then lumber prices shoot up like someone just flipped the price board upside down. You are left confused. Your contractor backs off, and the bank is not waiting around. Sounds far-fetched. Unfortunately, that is exactly what is happening as the US and Canada clash over tariffs, shaking up the lumber market, driving home prices higher, and leaving American homebuyers to carry the burden. Since March 2025, the U.S. has imposed a 25% tariff which could rise to 40% on softwood lumber imported from Canada. Canada supplies about 26% of all softwood lumber used in the U.S., so the impact has been swift and sharp. Construction, furniture manufacturing, and lumber distribution companies across the U.S. are feeling the heat. Big names like Weyerhaeuser and West Fraser have already reported significant drops in profit margins. Orders are delayed due to raw material shortages. According to ResourceWise, softwood lumber prices have been climbing steadily since April and now sit above $650 per cubic meter, about 18% higher than the same time last year. If you are planning to remodel your kitchen or build new shelving, expect to pay more. A hardwood floor set that used to cost $1,900 could now run you $2,300, and that is if you can even get the materials on time. For new homes, rising prices are adding tens of thousands of dollars to construction costs, forcing younger buyers in states like Texas, Arizona, and Florida to recalculate their budgets. It is not just about lumber. The entire U.S. real estate market is caught in a domino effect. Data from the U.S. Census Bureau shows that new home sales in the second quarter of 2025 dropped by 6.6% compared to last year, while new home inventory hit its highest level since 2007. Why? Material costs are up, supply chains are tangled, and interest rates remain high, pushing developers to put projects on hold. If you are currently renting and hoping home prices might come down soon, that hope is slipping further away. In California, a new apartment listed at $420,000 at the beginning of the year is now being resold at $455,000, all in less than 6 months. The rising costs of construction are making it harder for young families to settle down, while landlords are left with no choice but to raise rent just to stay afloat. While Washington turns up the pressure, Ottawa is quietly making moves of its own. Canada's largest pension funds, like CPP Investments and CDPQ, have already invested over 1,000 billion Canadian dollars into assets and businesses in the U.S. Bloomberg reports that in 2024 alone, over 100 billion Canadian dollars in new capital from these funds flowed into American markets. This gives Canada a serious lever in trade talks. They can threaten to shift investments if they feel the terms are unfair. Big players in real estate, infrastructure, and finance are starting to worry. A major pullback by Canadian funds could shake up both the U.S. bond and stock markets, which in turn could impact the retirement savings and asset values of everyday Americans, especially in states like New York, Illinois, and Washington, where Canadian investors hold significant property. The clock is ticking. If the U.S. and Canada cannot strike a new trade deal by August 1st, nearly all goods imported from Canada, including cars, steel, food, and energy could face tariffs as high as 35%. According to the Congressional Budget Office, CBO, this could raise the cost of Canadian-made cars by $4,000 to $6,000 each. Inflation is also expected to rise by an extra 0.4 percentage points in 2025 to 2026. A Toyota or Honda assembled in Ontario, currently priced at $28,000, could shoot up to $32,000 if the tariff kicks in. And it does not stop with cars' frozen meats. Cheese, fruit juice from Canada might go up by 10 to 15%. For the average American household, This means spending a few $100 more each month just to cover the basics, all because of one political misstep in trade negotiations.
It's June 4th, the day Donald Trump's 50% tariffs on Canadian steel and aluminum go into effect. This is a big deal.
Something big just happened and almost no one is talking about it. A sweeping 50% tariff on Canadian steel and aluminum is driving up costs on everything from auto parts to household appliances, shaking the U.S. economy and putting the future of American manufacturing and cleaner transportation on the line. In July 2025, President Trump announced a 50% tariff on Canadian steel and aluminum, marking the highest trade barrier between the two countries in decades. Within days, prices for essential materials soared, directly affecting everything from beer cans to auto parts. For the average American consumer, these increases arrive during an already difficult period of inflation. If a can of beer climbs by 8 cents and the cost of a new refrigerator rises by $120, families will see their monthly expenses stretch further. Small businesses, especially those relying on affordable metal supplies, face higher operating costs, potentially translating into fewer jobs or reduced investments. According to industry analysts, if these tariffs persist, construction material costs could rise by up to 15% by the end of the year, and manufacturers warn of a possible $2 billion increase in consumer costs annually. Canada responded swiftly, led by Mark Carney with a three-pronged strategy. First, it matched U.S. tariffs, targeting goods like washing machines, farm equipment, and orange juice. About $12 billion in U.S. exports now face new duties, with soybean prices down up to 6%, hitting thousands of Midwest farms. Second, Canada teamed up with Japan and South Korea to file a WTO complaint, challenging U.S. tariffs. While a legal win could reverse them, the process brings months of uncertainty. Small exporters face delays and renegotiated contracts, with analysts projecting a $500 million drop in U.S. exports to Canada over 6 months, impacting jobs in states like Michigan and Iowa. Third, Canada is building a trade coalition to gain leverage in future talks. If measures persist, U.S. businesses could see supply chain costs rise 8%, while average families may pay $140 more annually for affected goods, posing challenges for retirees and those on fixed incomes. For America's fast-growing electric vehicle sector, the new tariffs strike at a critical vulnerability. U.S. automakers such as Ford, GM, and Tesla rely on Canadian steel and aluminum to build electric trucks and SUVs now, as Canada retaliates with its own tariffs. The cost to produce a single electric pickup has jumped by $8,000. The popular $7,500 green tax credit under the Inflation Reduction Act is effectively wiped out by these new expenses. Industry insiders estimate that companies must absorb up to 70% of these additional costs, eroding profits and slowing investments just as the election season heats up. For workers, this could mean fewer new jobs, and for consumers, higher prices making electric vehicles less accessible, especially for families aiming to transition to cleaner transportation. On July 21st, Canada mandated that all steel used in federal projects be domestically produced, effectively blocking Chinese steel routed through the U.S. Simultaneously, it's expanding export corridors to the EU and Asia, leveraging Europe's carbon tax to promote cleaner metals. Mark Carney's bold strategy positions Canada to lead the global green metal supply chain if the U.S. doesn't shift course. Experts predict Canadian steel exports to Europe and Asia could rise 30% by 2026, while U.S. manufacturers may face higher costs and tougher competition without a new deal.
There is still a long way to go to make up for the lost revenue that isn't going to the United States. And obviously some of that is also going internally in Canada, but it doesn't compare to the trading partner that we did have that no longer exists in that same sort of reliable sense.
Imagine this. Your favorite neighborhood shop suddenly stops accepting dollars and only takes euros or yen. Sounds ridiculous, but that's exactly what's starting to happen in the world of North American finance, and Industry Canada is quietly redrawing the economic map, and American businesses may soon have to catch up or lose out. It's a quiet summer afternoon in suburban America. Many are reviewing their retirement statements, wondering if their savings will last. Yet north of the border, things are shifting. In June 2025, Ontario issued $2 billion in bonds without any U.S. bank involvement, a first in over a decade. 3 months earlier, Alberta raised 1.25 billion euros, led by European and Canadian banks. For Americans whose retirement savings rely on pension funds, this may seem remote. But as Canadian bond deals increasingly bypass U.S. banks, pension portfolio growth could slow. Experts warn that if underwriting revenue drops 15 to 20% annually, average returns on some U.S. retirement accounts may fall by 0 to 2 to 0.3 points. For someone with $300,000 saved, that's $600 to $900 less income per year, enough to affect essentials like healthcare or groceries. For years, Canadian copper has quietly supplied nearly 1/5 of America's refined copper. Now, as Ottawa pushes back against new U.S. tariffs, that supply chain feels more fragile than ever. Auto factories in Michigan and housing projects in Texas, places powered by middle-aged workers, may soon scramble for copper. In the next 6 months, deliveries to U.S. plants could fall by up to 5,000 tons. A veteran Detroit engineer, almost 50, sums it up. We used to wait a couple weeks for copper. Now, it could be a month or more. Delays and postponed paychecks may not make headlines, but they're real for thousands of families. Decisions in boardrooms and courtrooms echo through lunchrooms and living rooms nationwide. Every electric car contains nearly 80 kilograms of copper, a quiet force driving commutes and hopes for a greener future, especially for budget-conscious middle-aged families. A 5-cent increase per pound adds $90 to each new car. With tens of thousands produced monthly, that's millions in extra costs. Upgrading a single mile of high-voltage line now takes 10 more tons of copper, adding hundreds of thousands to big utility projects. For families, these costs hit home. Utility bills are set to rise $20 to $25 per household this summer. It's hard to save when everything keeps costing more, sighs one father. All these increases add up, making an electric car, or just a cool home in July, feel less attainable than ever. A clear warning. If the U.S. doesn't back down by July 22, Canada will impose tariffs on 125 billion Canadian dollars of American goods, from medicine and smartphones to groceries. The numbers are telling. In one quarter, Canadian exports to the U.S. fell by 18,000 tons, while shipments to Asia soared. For middle-aged Americans, especially those juggling healthcare and family bills, the impact will come fast. Prescription drugs from Canada could rise $8 to $10 per box. Smartphones may cost $50 to $70 more, and grocery prices may quietly creep up. Analysts warn these tariffs could threaten at least 15,000 American manufacturing jobs by year's end. Sometimes, what we count on most reminds us how fragile certainty is.
And so it's going to be who has that price sensitivity to move it, and who can get cheaper prices for systems that are already built for natural gas.
Can a massive gas project in Canada reshape the global energy map? With an initial export capacity of 14 million tons of LNG per year, Canada is officially stepping into the big league. But as Asian powerhouses like India and China accelerate their shift away from coal, who stands to gain? And how will global markets respond to this shifting energy dynamic? On June 30th, 2025, Canada launched its first direct LNG export from Kitimat, British Columbia, ending a 30-year reliance on U.S. pipelines. Previously, Canada sent 8.8 billion cubic feet of gas daily to the U.S., earning about $8 billion annually. After the Trump administration imposed a 10% tariff on Canadian energy, Ottawa shifted focus to Asia. For millions of Americans, this change disrupts the steady flow of affordable Canadian gas. Regions like the Midwest and Northeast, which depended on it for up to 40% of winter heating, could see energy bills rise 10 to 15%, unless U.S. supply chains adapt. U.S. gas exporters may also face stiffer competition in Asia, threatening jobs and investment. In response, U.S. lawmakers may seek to renegotiate trade terms or reduce tariffs. At the heart of Canada's energy shift is the $40 billion LNG Canada project, a joint venture by Shell, Petronas, PetroChina, Mitsubishi, and KO Gas. The facility aims to export 14 million tons of LNG annually, with potential to double to 28 million. This expansion is enabled by the 670-kilometer coastal gas link pipeline, connecting Dawson Creek to the Pacific coast. The new route halves shipping time to key Asian markets, from 20 days to 10, bypassing the costly, congested Panama Canal. As Asian buyers pivot to Canadian LNG, U.S. ports risk losing billions in transit fees and trade. Canada's faster, more efficient delivery could outcompete U.S. LNG, especially during peak demand. U.S. workers tied to legacy pipelines may feel the impact, prompting industry groups to push for export infrastructure, upgrades and incentives to maintain global competitiveness. Asian energy buyers, eager to replace Russian gas and coal with cleaner, neutral sources, are signing long-term LNG deals with Canada. Japan, the world's top LNG importer, plans to boost Canadian purchases by 20 million tons annually from 2026. South Korea is expanding LNG storage by 50%, while China has secured contracts through at least winter 2026. Analysts say Canada could become a top 5 global LNG exporter if Phase 2 is approved. This pivot reduces demand for U.S. LNG in the Pacific, potentially costing American firms billions, and widening trade deficits with Asia. U.S. energy companies may shift focus to Europe or Latin America, though logistics pose hurdles. Politically, the trend could spur Congress to revisit energy diplomacy and invest in clean energy to regain market share. Ironically, Trump-era tariffs aimed at pressuring Canadian producers have accelerated Ottawa's push for market diversity, reducing U.S. dependence. Washington has lost access to cheap Canadian gas and influence over the cross-border energy corridor. Analysts warn Canada may respond with trade measures. Notably, Canada has safeguarded its interests while giving the Indigenous Haisla Nation equity in LNG Canada, a model praised for responsible development. The U.S. now faces a future of less reliable, affordable energy, especially during peak demand. Households and businesses may be more exposed to global price swings. Political debates could emerge over reversing tariffs or striking new energy deals. Rising tensions risk disrupting supplies and causing economic fallout on both sides.
I think fear of border patrol situation is definitely deterring a lot of tourists.
It's not just tourists who've disappeared, so has our revenue. Just weeks into 2025, thousands fewer cars and shoppers are crossing the US-Canada border, and communities from Buffalo to Niagara are feeling the shockwaves. Lost jobs, shrinking sales, and rising costs for families. There was a time when a quick trip over the Peace Bridge was just part of daily life for folks living along the border. But this February and March, more than 35,000 fewer vehicles crossed at Buffalo's Peace Bridge, and nearly 30,000 fewer crossed the Rainbow Bridge. Compared to last year, you don't need a spreadsheet to feel the change. Local diners are quieter, and shopkeepers see fewer faces each week. Erie County's tax revenue is already down 7%, forcing town halls into tough decisions. Cut clinic budgets, delay road repairs, or reduce police overtime for homeowners and retirees. These aren't just numbers. They mean the library closes early or doctor visits take longer. As funds tighten, families feel it at the register. Groceries and gas rise maybe $10 or $15 more a month. But enough to notice, small businesses quietly let part-time staff go, hoping for a rebound before summer. It's a chain reaction, started by fewer cars on the bridge. Felt right at home. Not long ago, American brands filled Canadian homes from cereal to kitchen gadgets. Now, with 78% of Canadians vowing to buy local and 59% avoiding U.S. products, a new attitude is emerging. It's more than patriotism, even Amazon feels it, as 41% consider leaving the platform. For middle-aged Americans with Canadian ties, the effects are clear. Returns from Canada are falling. Savings buy less. And shopping habits must adjust. Back home, this means prices for some American staples are up 3 to 5% as brands try to offset Canadian losses. So expect to pay a few dollars more for things like paper towels or coffee. E-commerce firms could see $20 to $30 million less revenue next quarter. Ultimately, it's not just politics, it's a new kind of squeeze at the store. Remember when border towns buzzed with Canadians? And every fast food spot filled up after hockey games or shopping sprees. This year, it's quieter McDonald's. Wendy's and Burger King say they've lost hundreds of millions, mostly from Canadians staying home. For middle-aged managers and franchise owners, empty dining rooms mean tough choices. Many are cutting shifts. Some staff lose hours entirely. Families depending on those paychecks now face new worries. Staffing costs are down 10 to 15%, so each location might cut 3 to 5 jobs just to survive. Losing work at a burger joint isn't headline news, but for those in their 40s and 50s balancing bills and tuition, it's a serious hit. The golden arches remain, but business is far from booming. Canadians have long visited the US for concerts, holidays, and shopping, but this February, travel plunged. Air arrivals fell 13%. Land visits dropped 23%. The impact? Roughly $2 billion lost revenue and 14,000 jobs, mainly in hotels, restaurants, theaters, and campus roles. For tourism workers, it's more than a quarterly figure. It can mean making or missing the mortgage. Businesses report monthly losses of $150 to $200 and are cutting 10 to 15, mostly part-time or seasonal jobs. For families relying on those paychecks, the downturn hits home, showing that when Canadians stay away, U.S. Main Streets feel it, too.
We will introduce a tariff rate quota level for steel products at 100% of 2024 volumes and apply the same 50% tariffs on imports above those levels.
Nobody expected this. Not the factory foreman in Ohio. Not the policymakers in Washington. Not even the welders on the midnight shift. But Canada just made a quiet move that could rewrite the rules of North American industry and upend thousands of American jobs. There was a time when steel quietly held American towns together, from bridges to factory hums in Ohio and Michigan. This week, Canada drew a sharp line. Steel import quotas for most countries cut in half. With any extra facing a 50% tariff, U.S. Steel gets a brief reprieve, but worries remain. For welders, machine operators, and middle managers mostly in their 40s and 50s who rely on exports north, the news hurts. If Canadian buyers turn elsewhere or cut back, U.S. steel exports could drop 10%. That's not just a number. It could mean a layoff instead of a mortgage payment for 5,000 Rust Belt workers. Such demand shifts don't just hit factories. They can nudge up the cost of things like rebar or fridge shells. Prices for these basics might rise 2 to 4% in some areas, a small uptick, but one that strains already tight family budgets. Steel isn't just girders and beams, it's jobs that feed families and pride in lasting work. Now, Canada will require all federal construction to use Canadian-made steel, from bridges to public housing, for U.S. steelworkers and small businesses, especially those long-supplying Canadian projects. It's unsettling. Lost contracts or canceled shipments put steady paychecks at risk. Experts say U.S. specialty steel firms could lose $200 to $300 million yearly, leading to less overtime, smaller bonuses, or even layoffs in small-town plants. Meanwhile, U.S. contractors may see higher imported steel costs, making school or road projects harder to finish on budget. Sometimes, the real cost of policy is the uncertainty it brings to those who depend on hard, honest work. Steel towns know what it means to fight for survival. Now, Canada is investing over $1 billion to help its steel industry modernize, expand, and compete globally. 10,000 workers will get retraining and income support, with $70 million Canadian dollars dedicated to that. For American steel businesses, the timing is tough. As they face tariffs and rising costs, Canadian rivals gain new equipment, cheaper loans, and strong government support. U.S. producers could lose up to 8% of their Canadian market, a $400 million hit. It's more than boardroom talk. If Canadian steel prices fall by 5%, U.S. exports will struggle even more. For workers used to uncertainty, the next big order or pink slip could come any day toward a self-reliant steel economy. Steel once moved freely across the border, tying the U.S. and Canadian economies. Now, as Canadian leaders call this a historic turning point, things have changed. The old model, 90% of Canadian steel going to the U.S., is fading, as Canada aims to become more self-reliant across all 13 provinces. For middle-aged Americans on factory lines or managing shifts, the risks are clear. If Canada changes its steel deal with the U.S., America could lose its place as top buyer, and supply chains on both sides may unravel. The result? U.S. steel prices may rise 6% in the next year, increasing costs for cars, appliances, even construction beams. For those devoted to manufacturing, it's a reminder. Steel's strength can falter quickly when policies change and old partnerships are tested.